let's wrap up the day and the week in trading. Rick Szpila is with JPMorgan Futures. He's at the CME in Chicago. And a few blocks away at our Bloomberg Bureau is Jim Bianco, president of Bianco Research. The firm specializes in how economic data, like today's jobs report, affects the financial markets. Jim, let's get your take, first of all, on the jobs report. What do you think about the number gaining fewer jobs than expected, but coming down to 9.4%? Is everything better?
It's not really. I think the 9.4%, as you talked about, is about a lot of people leaving the workforce. The jobs growth number at less than 150,000 does not keep pace with the growth of population and immigration. So that number has got to get at least above 150,000 before we would really start to see the unemployment rate come down, other than the 1 month quirks that we have right now. So on balance, it's a pretty disappointing number for at least this month.
Hey, Rich, you agree? I'm curious what the kind of tone was there on the floor after the jobs report and how it's played out throughout the day in terms of trading.
Well, I think in terms of how the number was taken, the immediate snap higher across the entire fixed income curve down here at the Merc told you the story right there. It wasn't nearly what people would have wanted in terms of being better for the economy. In fact, it highlights really the sort of uneven, circuitous route that we're taking out of this. And everything was higher on the day. Everything stayed higher on the day on the fixed income side. The curve steep in 5s to 10s, 10s to 30s. The short end was firm all through the day. And in contrast to the equity markets, which started a little higher and have come back down, there was no doubt about the interpretation of this number from the fixed income perspective.
And Jim, I mean, how do you make sense of, I'm listening to Zara talk about KB Home, an unexpected fourth quarter profit. We know the housing sector is still troubling, but yet KB Home pulls one out here. You get the jobs report. That's a little disappointing. It feels like 2 steps forward, 1 step back constantly. How do you digest that, and how do you kind of devise an investment strategy here based on all of this?
You're right. It is the 2 steps forward and 1 step back, and you forgot the other elephant in the room, and that is the Federal Reserve policy with QE2, which kind of is a cloud. Hopefully, the Fed thinks a white cloud over everything, and I think that that's really the key point right now. As we move into 2011, I think the determinants are going to be whether or not QE2 continues, which I think it will through its completion, whether or not it's successful, or if it creates inflation. I don't think it's going to be as successful for the economy, but I do think it will provide underlying support for risk markets. It's been the stock market, as you mentioned, is up 6 weeks in a row. I think a lot of it has to do with the Fed printing money, and yes, that's what they're doing. And I think that that will continue to be a positive for the market. So that's the big fundamental right now. The rest of it, yes, KB Homes, the jobs, and all of that stuff is going to be cross currents unless or until QE2 is over.
But I just got to ask, what do you think about the market? I mean, if the Fed continues to print money, do you like the market then? Do you stay on board as long as you got the Bernanke put here?
Yes. I think that that's what's been the primary driver of the market since August. August 27th, Jackson Hole, the market's up 21% since then. And I think that the primary driver has been at the Jackson Hole speech when he said QE2 was coming. And I think as long as that is continuing to be the case, that is going to be a big positive for the market. Now, it's going to end at some point this year, and then we'll have to deal with that when it comes. But it's not ending right now.
Let me give you a little now hear this action. Fed Chairman Ben Bernanke was on Capitol Hill this morning. Senator Mark Warner of Virginia asked him how the markets would react to more stress on the deficit, and this was his response.
Nobody doubts the United States has the economic capacity to pay its bills. It's really a question, do we have the political will to do that? And demonstration of the political will, that's what the markets are watching. Is the Congress and the public and the administration, are they able to demonstrate that they are serious and that they have enough willingness to work together to make progress?
Jim, this kind of brings to mind something that Neil Ferguson talks about, and that is that if the Fed continues in this manner, that the markets may react negatively because they're so worried about the U.S. deficit. Do you buy that?
Oh, yeah, I think that there's a lot to that. At some point, the deficit is going to be a problem. And if you want evidence of that, look no further than Europe. Europe has got debt problems all over the place because they've spent and they set up situations with their governments where the markets have decided that they're going to have a problem paying their bills down the line. And that's why sovereign debt has been rising in Europe. We're at risk of following them in those footsteps if the markets start to fear that we're going to have the lack of a political will to pay our bills as well, too.
Hey, Rick, it's Dominic. You had mentioned earlier in your kind of opening there about the rates kind of credit side of the equation here. About that kind of fixed income side, we saw a pretty steep drop in yields for the 10-year bond, and economist estimates are for 3.16% by the end of March. Is this an opportunity for people to be buying bonds right now if we continue to see a weaker economy, perhaps less jobs than we kind of expect in the future here, Rick?
I think you end up seeing a bumpy road going forward in terms of us coming out of this. And the thing about it is, I think one needs to look at one needs to look at be in a part of the curve, A, that you're comfortable with, and B, that you have some sense of what the trading range has been. I think since we've been coming out of this over the last 18 months to 2 years, you've seen the 10-year sort of get in defined sort of roughly 50 basis point trading ranges. That being the case, a lot of folks were wondering going into the number today whether or not we're going to see 10 years reestablish a new trading range, say maybe 3.25 to 3.75. But it looks like we're moving back into the 310 up to 350 range. So if you believe in that, if you look for that range trade, then it was an opportunity to get in.
Jim, let me ask you, because doesn't it feel like, though, things are certainly getting better? Like I said to you, 2 steps forward, 1 step back, but we are making steps forward here. Doesn't it feel like things are getting better, and that provides a much better backdrop for continued corporate earnings growth here and gains in the stock market?
Yes, things are getting better if you compare them to last summer when the word that everybody was using was double dip. If you said things feel like they're getting better, I'll harken back to a 21% rise in stock prices is the primary reason we're feeling better. The unemployment rate is really not getting better. We're still debating whether or not housing is actually bottomed, and it's still unclear whether or not it has at this point. So there's a lot of headwinds in the economy, and those headwinds make a forecast like 5% GDP growth for 2011 a very aggressive forecast. As you mentioned, the second highest on the street. That would really be, in my mind, quite a shock if we were to see numbers that strong.
Hey, Rick, you got about 30 seconds here. Carol's talking about 2 steps forward, 1 step back. What could be a scenario that leads to 2 steps back? In other words, a turn in the economy. What are you looking for the downside? What does that mean?
Well, I don't think. I frankly, we're not concentrating much on it. I think the trajectory, as many of the guests and the dialogue have pointed out today, is in the right direction. It's just a question of, as we move up the switchbacks here, with the Fed providing some impetus and some push, whether or not we don't get a wheel off the edge.
Hey, guys, we got to run. Jim Bianco, Rick Szpila, thank you so much. We appreciate your time today.